Hello, my name's Darlene Felsch. I'm a certified practicing accountant and an accounting tutor. This is part of a video series I've created for Year 11 and 12 students to fast track them through their studies in just 10 weeks. I hope you enjoy the program. Introduction: Goods and Services. Look all around you and notice all the different types of businesses that exist. Every business buys and sells goods or services. When a business buys and sells goods and services, money flows in and out of the business. Examples of goods: cars, bikes, mobile phones, TVs, clothing, furniture, hardware, etc. Examples of services: getting a haircut, getting your car serviced, getting your mobile phone fixed. With services, no physical item changes hands. Instead, a service has been provided. Transactions and source documents. Every time goods or services are bought or sold, it's called a transaction. For every transaction, a source document, either paper or electronic, is generated. For example, if you purchase a drink at the supermarket, once you have paid, you'll be given a receipt to prove that you purchased the drink. This receipt is an example of a source document. Every time you buy goods or services, you will receive a source document from the supplier. This document provides evidence of A, what you purchased, B, when, and C, for how much money. Similarly, every time you sell goods or services, you will give a source document to the customer. This document provides evidence of A, what you sold, B, when, and C, for how much money. When you run a business, it is very important that you keep all of these source documents. Source documents provide evidence of all transactions undertaken by the business. Entering transactions into the accounting system. These source documents are then entered into the accounting system by a bookkeeper, or sometimes in a very small business they are entered in by the business owner or a family member. Transactions are also grouped together in similar categories. For example, if you have a business in the car industry, you might have categories like 1, sale of cars, and 2, servicing of cars. If you owned a mobile phone shop, your transactions will be grouped into the categories of 1, sale of mobile phones, and 2, sale of mobile phone accessories. The transactions are then recorded in the accounting system. The accounting system will then use these grouped transactions to produce financial reports. Financial reports are used to show people how the business is going and to help the relevant people make decisions about the business. Debits and credits. Understanding debits and credits is the foundation of learning all accounting. As you advance in your accounting studies, you'll begin to understand the complexities of debits and credits. But when you're first beginning to learn about debits and credits, it can be helpful to think of them as debits being in and credits being out. Debits are something of use coming in to the business. Credits are something of use going out of the business. Examples of debits: cash coming into the bank. The use of the cash has come into the business. Purchasing a motor vehicle. The use of a car has come into the business. Purchasing equipment. The use of the equipment has come into the business. Purchasing a desk and a chair. The use of the furniture has come into the business. Purchasing of inventory or stock. The inventory is being held in the business, ready to sell. Renting an office. The use of the office has come into the business. Buying office supplies. The use of the office supplies has come into the business. And paying for electricity. The use of the electricity has come into the business. Examples of credits: paying cash out of the bank. The cash has gone out of the business. Selling a motor vehicle. The motor vehicle has gone out of the business. Selling computer equipment. The computer equipment has gone out of the business. And selling inventory or stock. The inventory has been sold and has gone out of the business. The accounting equation. The next concept is called the accounting equation. The accounting equation is assets equals liabilities plus owner's equity. Assets are recorded on the debit side, the left-hand side of the accounting equation. Liabilities and owner's equity are recorded on the credit, or the right-hand side of the accounting equation. Debits are often written as DR for short, and credits are often written as CR for short. Double entry accounting. This brings us to a concept called double entry accounting. This works just like a set of old-fashioned scales. In accounting, both sides of the scales must always be equal. They must balance. There is a minimum of 2 entries for every transaction. The total of the debits in and the total of the credits out recorded in the accounting system must be equal. T accounts. When we're first learning about how to record accounting entries, we use something called a T account. T accounts come from the accounting equation. When you look at the dark outline in the diagram of the accounting equation, you can see that it looks like a capital letter T. The debits in go on the left-hand side of the T account, and the credits out go on the right-hand side of the T account. That's the end of the lesson for today. I hope that you've enjoyed the lesson. We'll see you next time. Bye.